With global debt now at a staggering 300 trillion, roughly the size of the entire global economy, my guest today warns of what he calls the Stalingrad moment of the dollar, a tipping point driven by debt traps, Fed illusions, and central banks dumping U.S. treasuries for gold. He sees gold not just as an asset, but as a lifeboat in this unfolding crisis, potentially signaling a global financial reset. Please welcome back to the show, Matthew Piepenburg. He's a former transactional attorney and hedge fund manager who navigated the NASDAQ bubble of the early 2000s. He's also the author of Rigged to Fail and a vocal critic of unchecked sovereign debt and currency debasement. Matthew, as always, a pleasure to speak with you. Welcome back.
Well, it's always a pleasure to speak with you, and I'm glad to be back, so thanks for having me.
Look, it's a pivotal moment as we're speaking gold, getting that much-awaited four handle that anyone in this gold space has been waiting for years, and obviously we're going to talk about that.
Yeah.
And I want to talk and start with what you've dubbed the Stalingrad moment for the dollar. You say this is a pattern that has repeated throughout history. It's not just clickbait, but something we must be paying attention to so we don't fall in this trap. Matthew, please take some time to really explain to our audience why we have to be paying attention to the dollar scene right now.
Yeah, thanks, Daniel. I mean, there's so much, I don't want to say clickbait. There's a lot of drama. There's a lot of sensationalism in the gold space for years. There's this pawn shop asset kind of reputation, and certainly there's all of us in our book, talking our book, biased about gold. But I want to get away from just being an executive in Zurich talking gold, because it's really not about gold. It's about fiat money. It's about the dollar. It's about the history of fiat money. And it's really theft. And it's not mistaken theft or stupid theft. It's deliberate policy theft when countries are in debt up to their ears and no longer have good options. And they take from the people, and that's not a desperate act. It's really a cyclical act. And to put that into perspective, again, it just needs get away from boring themes and boring economists and just stick to some real historical moments. And then that helps build, I think, a case of placing the headlines into context without getting bogged down in a lot of gross history. But I wrote a book in 2019 called Rigged to Fail. And it's a game, really, Wall Street, and what I've seen in it, what I've studied, what I practiced in it. And unless you are prepared for this rigged to fail game, unless you're informed, you're going to be on the losing side, because the policymakers are not your friends. And that sounds sensational and maybe clickbaity, but it really is the debasement and devaluation of currency to monetize debt. That's open theft, but it's frog-boiled, it's very slow, but it repeats itself over and over. When policymakers are at that Waterloo or Stalingrad moment where there's nothing left to do but debase the currency to monetize their debt, and they can continue this game slowly and frog boil it eventually, but eventually we feel it. And eventually the man on the street loses, because Wall Street, as a metaphor, is very, very different set of values than Main Street. And there's a lot of dishonesty and cyclical natures of this. And what I see, I'll try to do this really quick so we can pull on all the other strings. But I see in historical patterns, from honest economists that go back to the 1500s to the 1970s to today, these patterns, and then current headlines, objective facts that are really confirming what is fatal math for the US dollar. Because what we're seeing is a credit cycle ending, which is really a dollar cycle ending. And as that debt credit balloon approaches a popping moment, that doesn't mean a stock market popping moment, it means a credit debt moment. And when that pops, the currency used to monetize that debt is always debased and devalued, and it melts like an ice cube. And governments, through their deliberately debased fiat money, are really insulting their citizens in a very slow and deliberate but intentionally complex frog boil. So again, policymakers are not your friend. And the way to put this into some historical context, and I'll stop in 3 minutes and we'll pull on any string you want. But look, from the 1750s, from David Hume, we know one thing: debt always destroys currencies. And there was Sir Thomas Gresham from Gresham's Law in the 1500s in England, who said that trusted money, when it circulates at the same time as debased currency, eventually people will spend the bad and hoard the good. They'll figure out that the fiat money is bad and that hard assets like gold are good. And eventually they'll replace the bad altogether. And that's what this other economist from the 18th century, a French guy named Adolphe Thiers, said. In a crisis, real money drives out the bad currency. And again, we saw this with Rome, in ancient Rome, with the denarius. It was all silver. And over a period of 200 years, they chipped away all the silver. It had no silver. We saw this in medieval Europe when gold was replaced with copper. Clearly, the more modern examples like Weimar in the 1920s, when prices were doubling every week, no one wanted to hold marks. They were like hot potatoes. So they fled to other currencies at the time, like the dollar or even cigarettes or barter or gold. And then there are classic examples in Zimbabwe or Venezuela. But these are all patterns that we can see. We could spend hours on each of these kind of historical moments. But the current headlines really are showing that just as Thomas Gresham and Adolf Thiers had warned, that the debasement of paper money leads to the preference for real money, that is gold, over real, fiat toilet paper, even if that paper is the world reserve currency. And this explains so many of the open signals, of which, again, each of these signals deserves their own episode, their own hour. But they're all around us right now, and they're not just coming from the gold bug camp. And I think if we put this in the perspective of how fiat money is debased to monetize drunken driving debt, we see this, and I'll just, the list is long and distinguished. We certainly see it with the BRICS rise and the open de-dollarization process that we've talked about ad nauseum, and the process away from the greenback and the U.S. Treasury, which is no longer a slow drip trend, but really a rapidly expanding direction. We see it with the DXY, which has gone from 115 to 98. We see it with central banks since 2014, had been net stacking gold and net dumping U.S. Treasuries as a reason. We see it in the 20% of global oil sales that are no longer in the petrodollar, that are occurring outside the U.S. dollar. We see it in the open panic and disintegration of the COMEX and London exchanges, who are seeing net outflows of physical gold because the counterparties want their gold more than anything else. We see it with the BIS, which has made gold a tier 1 asset. We see it with the IMF back during the COVID hysteria, which saw gold as a pure gold as a fundamental to its otherwise impure CBDC initiatives, which are slow boiling out. We see it in the 3 consecutive years of central bank gold stacking at record levels, over 1,000 tons per year since the USA weaponized the dollar back in 2022. We now know that central banks hold more gold than U.S. Treasuries on their balance sheet. That's the first time since 1996. And even Morgan Stanley saying there should be a 20% gold allocation. Goldman Sachs is saying there should be a 7% allocation. So the whales who are against sound money can't deny their clients want physical gold. We see it with Judy Shelton talking about introducing a gold-backed U.S. Treasury. We see it with Trump's tariff policy to try and monetize the debt. And certainly we see it with the desperation of the Genius Act to create stablecoin demand for otherwise unloved U.S. Treasuries and U.S. dollars. So just as Thomas Gresham in the 1500s and Thiers warned in the 1700s, centuries ago, the world is hoarding gold and turning away from bad money. And just as history warned, the U.S. dollar is being openly devalued to pay down a debt crisis of their own making. And I'll close because this is nothing new. In fact, it's recent history. In 1933, FDR, by executive order, confiscated gold overnight. It was at $20 an ounce. The next day it was at $35 an ounce, revalued. But when he did that, he devalued the dollar by 69% in order to make Uncle Sam's debt burden 69% less onerous. And of course, Nixon in 1971 totally welched on the US dollar and its gold backing and the world by removing the gold backing of the dollar. And since then, the dollar has lost quantifiably over 90% of its purchasing power. So this certainly made Uncle Sam's appalling bar tab easier to repay, but only by gut punching those who measure their wealth or their savings or even their portfolio returns and even their retirement in US dollars. So again, this is a deliberate policy of debasing the money that most folks measure their wealth by, certainly the US dollar, but any fiat currency. It's debasing the dollar or debasing fiat money. This is nothing new throughout history. And the loser is always the trusting citizen who believes that their fiduciaries, their elected officials, their policymakers with the PhDs and the Harvard degrees and the blue suits, but they're no different than a thief with a mask and a burlap bag telling you to put your hands in the air because they're slowly robbing you of your purchasing power. That is why gold is at all-time highs almost every week. And that's why it's hit the 4 handle a day. And that's why it's going to continue to rise. That is not an executive trying to sell his book. I want people to understand this is actually nothing new throughout history.
Wow.
Yeah, it's tragic. And
that is so incredibly said. And this may seem like a basic question, but I don't think I've ever asked you this.
Mhm.
What is it about gold that has allowed it to stand the test of time? As you say, it's the ultimate lifeboat. What is it about it that it can just survive anything that's thrown its way?
It's fascinating. Well, from it has a very limited supply or limited stock to flow. You can't print gold. You can't create more of it when needed. You can't debase it. It's literally indestructible. I mean, it's almost biblical in the sense that it was here before the universe was created. There was I saw Alistair MacLeod just a few weeks ago in England. I remember he was telling about this. I mean, it was literally there. It's literally there before we were here. And it has a limited supply. Unless a meteor comes from outer space and there's suddenly a massive oversupply of gold, it holds its value better than paper money. And because it can't be created at will or debased at will by politicians, sovereigns, monarchs, kings, democratically elected, or czars, it will always be a better store of value than a denarius or a paper money or anything that can be debased or devalued. And I think it has that kind of historical fixed supply. People could argue Bitcoin's the same way with its fixed supply, but gold is on the periodic table. It doesn't rely on electricity. It doesn't rely on hash protection. It doesn't rely on technology. It just sits there and does nothing, as Buffett says, but stare back at you. It's this pet rock. It's this historic relic. But no, it's far more than a pet rock or an historic relic. It's always been sound money for millennia. It goes way past ancient Rome. It goes back to the Persian first trading huts. It goes back to the Ming Dynasty. Whenever a sovereign, a monarch, a king, etc., gets itself into the back against the debt wall, the citizens and the powers that be will naturally lead towards something that holds its purchasing power, holds its value because of its fixed supply, its indestructibility. It's literally in our DNA. We have a small amount of gold in our bloodstream. There's something kind of supernatural about it, but it's honest. Unlike politicians, unlike policymakers, unlike treasury secretaries, unlike central bankers, gold just tells the truth. It does nothing but stare back at you and hold its value, while fiat money can be swapped, exchanged, debased, devalued, traded, exported, inflated, and all these things. It can be very busy losing its purchasing power, but gold just holds its value. And it's going up to these exponential levels only because fiat money, including the world reserve currency, is being debased at such exponential levels. So gold has almost a supernatural, historical, and inherent quality that's simply unmatched. And that's why it's in such demand, and it will always get the last laugh over dying fiat paper money. It just always does.
We'll get right back to the interview, but this is an important moment to ask yourself, when the next crisis hits, will you be properly positioned or wish you prepared earlier? I've spent over 2 decades reporting on global economic shifts, and what's happening now is unprecedented. In moments like this, timely decisions are critical. That's why we've put together the Private Wealth Playbook. It's a free guide showing you how to use gold and silver strategically for protection, privacy, and long-term performance. Click below or visit DannyReport.com to download it now so you can move forward with clarity and confidence. Now back to the show. So this run up to the 4 handle now, do you think retail investors are waking up to exactly what you laid out, or is it still mainly driven by central bank demand here?
Well, right now it's still clearly driven by central bank demand, especially in the West. And even Western central banks aren't really fully catching on. I was listening to a conference the other day with some Western central bankers in Europe, and former central bankers and former ECB officials, which just literally speak from a playbook. It's almost appalling. They're still seeing gold kind of as, a misunderstood asset. They're ignoring what the other banks of the world, especially the Eastern central banks, who have a long history of being used to being the dog wagged by the tail of Western policymakers who've been exporting their inflation and their world reserve currency around the world to the detriment of everyone. That's the famous, John Perkins book, The Confessions of an Economic Hitman. This exported inflation, this weaponized currency, which no one trusts, post 2022. Central banks have been quietly stacking gold since 2014. That increased dramatically after 2022 when we weaponized the world reserve currency against the advice of Robert Triffin and others. But now they're accelerating this. There's always been a distrust. I mean, you don't have to like China or Russia. You don't have to like the sanctions. You can like the sanctions. You can have your own views on Putin. But when we weaponize the neutral reserve asset, like the world reserve currency, trust in that already unloved U.S. Treasury and U.S. dollar increased exponentially. So the rise of the BRICS and the policies from the BRICS increased exponentially. The amount of net settling done outside of the dollar, the petrodollar, et cetera, that all increased at a rapid pace after 2022, as did gold stacking, tripled by central banks after 2022. That wasn't a coincidence. The jig was up. We'd gone too far with that. And so now the central banks in general, to answer your question, are by far the biggest buyers. It's kind of funny. I heard it was a Peter Schiff. The central banks see the writing on the wall because they literally created the wall. So they know that the currency is being debased by other central banks, certainly by the Fed. They know that we're in a debt corner. They know there's nowhere to go but down for fiat money. So the central banks, the very criminals who created this situation, especially now, are the first to be buying it, especially in the East. What's ironic is the UK and the US, the biggest sinners, are the slowest to the table. They're still trying to play the game that they have the power with this dollar. And we should talk about people who believe in a strong dollar who make a case for it. The writing is on the wall. This fiat money is part of history. It is being debased at an accelerated pace. It's sad to me that more retail investors aren't catching on, mostly because for decades they've been told by their registered investment advisors and their bankers at Goldman Sachs or Morgan Stanley or the smaller banks. They've all been ignoring gold, saying gold was too volatile an asset, even though it's outperformed the S&P for the last 25 years.
Along those lines, Matthew, I mean, just this week, the Swiss National Bank, and it may be a special case, but if you're looking for a switch in the behavior of central bank reserve managers and their currency preference, then the Swiss case is a curious vignette because the dollar is off the menu now there, Matthew. So is this a sign of the times? I guess to your point, it is.
Again, it's just added to that long list of the sign of the times of the current headlines. You know, again, from Morgan Stanley going from 60-40 to 60-20-20, that's a Wall Street whale now openly saying that gold matters and that it should be a part of an allocation. You know, I know that people I know at Rothschild, at least in the London office, still aren't allocating, but in the Swiss office they are. So it's office to office. Goldman Sachs isn't offering the same kind of 20% allocation that Morgan Stanley is, but the very fact that these juggernauts, these too big to fail banks, which were deliberately trying to ignore gold for decades, can't help but see this. The Swiss National Bank can't help but see that the US dollar has nowhere to go, in my opinion, but down. And we should talk about the others who disagree with this because it's a valid point and we should look at the other side of the dollar case. But I think these are things I'm seeing on the street, so to speak, with conversations. These are things I'm seeing in the headlines. These are things I'm seeing with conversations with Europeans and Americans at big banks. I think at Goldman and Morgan Stanley, et cetera, it's not that the banks themselves suddenly got wise to sound money or being better fiduciaries and admitting and confessing what Powell can't confess, that we have drunk-driven our currency into a dead end because we've been printing money to monetize our debt, and we've been expanding the money supply by 40% since 2020. So of course we're going to have a debased currency, like the Romans had a debased denarius. I think what's driving these bigger players, whether it's the commercial banks in New York or the Swiss National Bank in Zurich, but certainly with the commercial banks, is the clients themselves aren't as stupid as their bankers. They can't help but see the debasement of the dollar. They can't help but see the devaluation. They can't help but feel it. Whether they're buying a Range Rover or a loaf of bread, even high net worth clients at these banks recognize that their dollar is getting debased.
And that's an important point, Matthew, that it is important to hear from the other side. And I just had Joel Littman on. I'm not sure if you're familiar with his work, but I mean, he is... he wouldn't say he's bullish the American economy. He said he's a realistic, and he says, you know, his counterpoint is that compared to other countries, the U.S. is still the strongest. That the U.S. currency compared to the other currencies is still the strongest. And, you know, he'll point to obviously the strength of the S&P, and that until we start seeing cracks in corporate debt, which he says he's not seeing yet.
Right.
That he'll make the argument the U.S. is still in much better shape than the others out there.
Look, and I just spent the weekend with a bunch of Argentinians sitting around in Asado, and their peso isn't exactly doing well, and it hasn't for decades, and they would certainly rather have dollars or euros, fiat money, over a fiat peso. So it's relative, and that brings into the question the DXY and the strong dollar camp. And look, I've had really compelling conversations a few years ago with Brent Johnson online, good discussion on the DXY, recently in South Africa with Henrik Zeeberg, who like Brent Johnson, sees a spiking DXY, kind of what he calls the last dance. And of course, Brent Johnson has a very intelligent milkshake theory, which has validity in a lot of ways. And I think, and recently Francis Hunt and I were double teaming poor Henrik Zeeberg on a different argument. But it's important to listen to what they're saying and not just take my word or Francis's word or other gold bugs words, because there is a compelling case that the DXY, or the dollar on a relative basis to other currencies, is still the best horse in the glue factory. I totally understand that, and I respect it. And I know I'm going to oversimplify this and upset Henrik or certainly Brent Johnson. But their argument has some merit in the sense that, look, what they're basically saying, and as your other guest was saying, is on a relative basis, what are you going to do? The ruble, the yuan, the yen, the rupee? It's not going to be anything but the dollar. And they point out that 58% of global FX reserves are still in the U.S. dollar. 80% of global trade is financed in the U.S. dollar. There's 13 trillion in global U.S. dollar denominated debt. There's euro dollar demand, 10 trillion there. There's probably another 90 or 80 trillion in FX swaps that are traded in U.S. dollars. So that any massive deleveraging of the U.S. dollar, U.S. treasuries would actually send the dollar up. In other words, it's almost too big to fail. And what's interesting about these conversations with Brent and with Henrik is all of us, including the Bitcoin guys we talk about, we can disagree on the DXY, but ultimately we all agree that gold is the final end game. What Henrik is saying, unlike Brent Johnson, though, he says the last dance for the DXY will happen when there's another market sell-off. If this market ever does mean revert, like in 2008, there'll be a run to safety. There'll be a run to U.S. treasuries, and there'll be a run to the U.S. dollar. And like in 2008, we could see a massive pullback in the gold price, like 30%, as we saw in 2008. So he's basically using 2008 as an example. And that's a valid point. But I think what's wrong with that is 2025 and the gold roll today is very, very different than 2008. The BIS has made gold a tier 1 asset. The IMF is talking about gold. It is not 2008. So when there is, or if there is, an uh-oh moment in this otherwise immortal stock market, which is monetized by the Fed and money printing liquidity, if there is an uh-oh moment, it will not be like 2008. There won't be the U.S. Treasury will not be the tier 1 safe haven lifeboat that it used to be in 2008. And the U.S. dollar won't be. Again, for that whole string set of reasons we've just seen, the world doesn't trust the U.S. 10-year. It doesn't trust the U.S. dollar the way it did in 2008. So I don't see it the same way.
You were saying it'd be worse than 08, Matthew?
No, I'm saying the market crash could be worse, but the gold price is not going to go down. It's going to go up because the money's not flowing to the dollar. It's flowing to gold. It's already pre-flowing, preparing right now.
Well, you saw Paul Tudor Jones' recent comments. He's like, we'll have one massive rally and then we're going to have a massive blow off top in stocks.
Yep. That's pretty much what Henrik Zeeberg is saying as well. But as Paul Tudor Jones has said, all roads lead to inflation. So that's why Henrik says there'll be a last dance, a flow to the U.S. dollar. I don't see it. But even if there is a last dance or no dance at all, even if there's a rally in the stock market, the safe haven the world is already turning to, not the retail investor, but the big investors, I certainly see it in Zurich, the safe haven today, just like the BIS has said, is now gold. I'm not saying that just as a gold bug, sell my book, although I could be wrong, but the evidence suggests that the safe haven in 2025 won't be the U.S. 10-year, it won't be the U.S. dollar, it will be precious metals and other hard assets.
Well,
that's what I see.
On that point, I got to get in a question here about silver. With silver breaking out, is silver a more accessible lifeboat for smaller investors? And how should one balance physical gold, silver, mining stocks in a portfolio to hedge against this Stalingrad moment?
Yeah, look, of course. I mean, people always say silver is the poor man's gold. I think it's the smart man's silver. And I think it's probably the most undervalued hard asset and certainly the most undervalued precious metal. Platinum's another interesting case. Silver, to your question earlier about what do retail investors do or what can they do, I have to be very respectful that many listeners here don't have $37,000 or $4,000 to buy an ounce of gold, and they feel like they've missed out. And they're trying to get through the month with mortgages, rent, tuition, or whatever. How can they possibly protect themselves? How can they take advantage of this open destruction of fiat money and protect themselves if gold feels too out of their reach? And to your point, silver, I think is the ultimate opportunity for those that are struggling to try and find a way to protect themselves right now when gold or an ounce of gold feels too expensive. Look, it's up more than 60% this year. We're not at the 1980 or 2011 gold silver ratios of 15 and 32, but there is a clear indication that there's a massive supply deficit in this metal. I mean, you've got open pit restrictions in Mexico, et cetera. But
Yes.
the market cap for silver is like literally it's half of Nvidia, for God's sakes. I think it's a $2 trillion market cap. So there is any even measurable increase in demand for silver will send its price up significantly. And it's certainly, you've got guys like David Bateman buying a lot of silver right now. I don't think it's because they're just speculating. They see an opportunity for massive 5x, 6x, 10x price appreciation, but it's a way to protect themselves in a precious metal that's affordable. And I think the fact that you've seen so many shorts on the otherwise dying COMEX or the LBMA
Yeah.
exchange in London, and despite the shorts, silver's knocking at the door of all-time highs. And because of its limited supply and because of its small market cap, I see a massive opportunity for silver. Again, I think it's the most undervalued asset in dollar terms or even priced in gold terms right now. And again, we're seeing huge interest in silver at our desk in Switzerland. It's not by accident. It's not just by desperate speculators. It's by people who see a massive price appreciation, but a precious metal that's actually affordable, especially for the man on the street, which is incredibly important. But I think if you're looking at silver, remember, you've got to have a long-term view. It's not just a speculation asset. It's a monetary metal. You have to hold it with a sense of insurance for dying paper money. And just like gold, you don't want to just trade it for a 2x return. You've got to be patient, as Rick Wool said. Silver rewards infrequently but extravagantly, and silver's position right now for some fantastic return.
That's a good way to say it. Wait, I just want to bring up two tweets to you. One, Jim Rickers earlier said, the path to 4K for gold was a long one,
Yeah.
but the path to 5K will happen much quicker now. Do you agree with that?
I do. I think it's like, again, it's always the inverse of the dollar. And since the U.S. is broke quantifiably on its balance sheet, as Hemingway described, poverty is happening slowly, then all at once. It's going to be the same thing with the disintegration of the dollar, slowly, then all at once. The gold price has been knocking from 1,600 to 2,200, 2,500, 2,800 to 35. It's slowly, then all at once. It'll be particularly the case for silver, which is like that little speedboat next to the juggernaut that is gold. When gold is hitting all-time highs and when gold is in a bull market, silver tends to dramatically outpace in terms of its speed of movement. I don't think gold's even in its bull market yet. We're clearly at a turning point, but gold is just in the first or second chapter. And I think the reason silver hasn't fully caught up, other than the mechanizations on the COMEX, et cetera, which is disintegrating, one of the reasons silver hasn't really seen that compression of the gold-silver ratio is because really the gold bull market is just beginning. And as it gets more traction, as it becomes more obvious, then I think silver, in terms of just pure price appreciation, is going to be a massive move. And so I'm highly recommending silver as an allocation, and I'm not alone.
As we're speaking, this just breaking news. Ray Dalio says today is like the early 70s and investors should hold more gold than usual. So just wanted to add that. Let me get this in. This was another interesting fun fact I wanted to share. Bitcoin now has a market cap of 2.5 trillion or 23.8 trillion less than gold. In other words, gold is currently 10.5 times larger than Bitcoin. So even if Bitcoin hits 1 million and gold was unchanged, Bitcoin would still only be 75% of the size of gold. I couldn't believe that stat, Matt.
No. Listen, I talked to Middlecoop and others who love gold. I talked to a lot of Bitcoin guys who also love gold. Middlecoop loves gold, but he's also bullish on Bitcoin. I'm not one of those who has to make fun or denigrate Bitcoin to be a gold guy. Again, you can debate that all day long. I'm happy for people in the Bitcoin camp. I have a lot of friends in the Bitcoin camp. I worry, and I'm just not convinced myself. I'm at 55 years of age at a point where I'm not trying to just get rich quick. I'm trying to preserve the wealth I have and certainly enjoy the price optionality of gold. I mean, Egon bought gold at 300. It's now at 4,000. Of course, he's happy to see gold go up.
Of course.
But his real motive was always wealth preservation. It's still my motive. My concern about Bitcoin, and it's only my personal concern, is I haven't seen it tested as other than a speculation asset. I don't believe it's a store of value with a standard deviation. I can't call it that yet. I know the Bitcoin crowd says that it's consolidating and it will eventually be that way. For me, the test will be how Bitcoin behaves when the NASDAQ has an uh-oh moment, the correlation to being just another incredibly overvalued tech stock to an actual store of value, an actual medium of exchange, or a unit of account. So far, it hasn't convinced me that. That doesn't mean that everyone who buys Bitcoin is deluding themselves. I'm just too cautious at this point in my life to compare Bitcoin to gold. It certainly, in terms of its annualized return, outperforms gold. It outperforms everything because in 1 year it was up 5,000%. So I'm
Yep.
still on the fence, but I'm not a speculator anymore. My hedge fund days are over. I'm a wealth preservation guy. Our entire business is wealth
Yep.
preservation. But look, we're certainly happy to see the price appreciation. But to me, when gold's at 5,000 and 10,000, and it will be, as Egon and I always say, be careful what you ask for because everything else is going to be so much more expensive. And that's the key to understanding precious monetary metals. When gold is at 10,000, a loaf of bread is going to be a lot more. And that's what's sad because the middle class, the retail investor who has trusted their wealth advisors, who has trusted their fiduciaries, their treasury secretaries, their central bankers, their leadership, red or blue, left or right, that leadership is rigged to fail. They always debase the currency. It's always the middle class who gets shafted first. And it's always in the name of something that's beyond the government's control. No, this is very, very deliberate. And inflation is not class blind. The first to benefit from inflation is always the top 10% because that money goes into asset classes like stocks and real estate, which the wealthy already own. So when you QE to the moon, that rips up the stock market. The wealthy get wealthier. The middle class, the bottom 90%, get stimmy checks, and then they look at their checking account and their saving account and their salaries, which are measured in dollars, which are melting ice cubes, and they always get shafted. And they don't even know why. They just feel themselves getting poorer. They still have the
Yep.
same dollar, but the dollar buys less. That's a crime, and it's not discussed enough. It's disgusting.
I just want to sneak in last question, because you brought up the Genius Act, and that made me remember our last conversation where you brilliantly pointed out where they had, the government was banning central bank digital currencies, but you said, they're going to take it away. I remember you saying this to me, take it away with one hand and it appears out the other hand. Is that what the Genius Act is in reality? Is it a central bank digital currency coming
Absolutely.
to us in disguise?
Absolutely. And again, this goes back to my Rigged to Fail book and the themes and my premise, and you can take it or leave it, is that the government's not your friend. The policymakers aren't your friend. To me, the Genius Act should be called the Desperation Act, but it's more than that. It's an insider trade. It's an insider trade to devalue the US dollar, export US inflation, enrich fintech like Tether and Circle Internet, and also enrich Uncle Sam and we'll explain why, but shaft the dollar holders. Because what they're doing is they're stuffing a bunch of US dollars into stablecoin. And we've seen this movie before of devaluing the dollar. And the idea is you, the man in the street or the guy in Argentina or the Turkish central banker or the Turkish doctor need US dollars because it's better than your local currency in Argentina or Turkey. So we'll throw you into this stable coin. You'll have now an e-dollar. Meanwhile, Circle Internet, Tether, JP Morgan, et cetera, the issuers of this get to take your dollar, invest it in T-bills. They have to, by law, invest it in US treasuries. So they get a yield, which they're making billions on as we speak. The holder of the stable coin gets nothing. They get an e-dollar linked to a treasury, which is volatile, which has 3 sigma moves, which is not stable, and it's not a coin. But the issuers make a fortune. Uncle Sam wins because, look, this is fantastic. I got new demand from my unloved, untrusted, unwanted U.S. Treasury. And I got new demand for the U.S. dollar. And Besant is looking to try and stuff this, the stable coins, get 3.7 trillion worth of these in the next 3 to 4 years, because that's a sign of how desperate Uncle Sam is. They need to create this stable coin to create artificial or direct demand for an otherwise unloved dollar in U.S. Treasury because no one else wants the U.S. Treasury. And I think, as Anton Kobayakov says in Russia, love him or hate him, that they're really doing this deliberately so they can inflate the amount of dollars coming into stablecoin, eventually debase the dollar, debase stablecoin because there's more control of that, and then revalue gold higher to help Uncle Sam get out of debt. That certainly helps Uncle Sam. It certainly helps Tether. It certainly helps Circle Internet. It certainly helps JP Morgan. It does not hold the sucker the newest sucker to buy the stable coin and create demand for this dollar. But it's perfect timing for a perfectly desperate government and a perfectly insider trade. To me, the Genius Act was a kingmaker. It was a kingmaker for Tether. It's an insider trade. We all know the parties behind it. Whenever I hear Marsh and McLennan come up, or some of these names that are behind it, I know there's something wrong. But look, again, it's kind of a Halliburton-like trade. It benefits the minority. It really screws the majority who are buying them. It helps Uncle Sam. And it doesn't change the fact that the dollar is still going to be devalued. And it doesn't change the fact that we'll probably revalue gold at some point much higher. But those are all separate silos. But no, stablecoin is not stable. It's not a coin. It's an e-dollar. And it is just as trackable, programmable, and seizable as a central bank digital currency. Instead of coming from a central bank, it comes from a fintech company. And that's it. That's the only difference.
It's all making sense.
It's rigged. It's rigged to fail you, the citizen, because the plumbing is intentionally complex. You're not supposed to understand how the COMEX works, how central banks works, how excess reserves work, and how excess reserves are going to be used to buy stablecoin. It takes hours to dig into this. You're not meant to understand that. I'm not trying to be sensational. It's sad because the average person who has a full-time job and 2 children and a mortgage, or you can't. And it's our job to try and make this simple without being sensational, not trying to get anyone a client at our company. We're a very expensive company, but I do think the people need to understand what's happening to them.
I hope shows like this help people. I really, really do. This is what I feel my purpose is. And I am grateful to have guests like you, Matthew, who are absolutely brilliant and can lay it out in an easy to understand way. And I thank you, because you're right. You know, but parents at home, we don't have time for this. We're dealing with, I mean, my kids are in kindergarten, Matthew. I can't tell you the amount of homework they already have. We're doing like an hour of homework already.
Yeah, that's crazy. So, I'm glad your platforms exist, though, because
thank you.
Every chance people get to, and they don't have to agree with anything we're saying or I'm saying or anyone else, but they deserve to get as many perspectives as they can. Honest brokers, as much as they can believe that, paper money, other ways to deal with the invisible tax that they're suffering from right now.
And we will continue this conversation, because I'm thrilled to finally meet you in person in Zurich at the Precious Metals Summit, a wonderful conference that Jessica puts on. So I look forward to seeing you there in November.
My pleasure. I look forward to it as well. It should be a great time.
So thank you all for watching.